Somewhere inside the vaults of the world's most powerful central banks, a number has gone missing. Not stolen, not lost, simply never reported. The official record says one figure. The trade data tells another story entirely. And the gap between those two numbers is larger than most economists are willing to admit on record. At the very same moment, a chart pattern is forming on the gold market. One that, on paper, looks like a warning sign, a signal that has historically meant only one thing. But the last time this exact pattern appeared, what followed was not collapse. It was one of the most explosive rallies in modern history. So the question is not whether something is coming, the question is whether anyone will see it before it's too late to act. Now, before we go any further into this story, may I ask a small favor? If you are someone who has spent years building wealth, watching markets shift, and learning lessons the hard way, then you already know the value of staying ahead of information like this. So if you have not yet subscribed to this channel, please consider doing so today. Think of it the way you would think of checking in on an old trusted friend, someone who simply wants to make sure you're not the last to know when something important is about to happen. It costs you nothing, but it could save you a great deal later. And one more thing, we would genuinely like to know, where in the world are you watching this from today? Drop your city or your country in the comments below. It helps us understand just how far this story is traveling, and who exactly is paying attention. Now, let's get into it. Somewhere in the offices of the world's most powerful financial institutions, a quiet decision was being made. It was not announced on television. It was not printed on the front page of any newspaper. And yet, this decision would soon explain one of the strangest mysteries in the gold market today. For years, central banks around the world have published reports telling the public exactly how much gold they were buying. Investors trusted these numbers. Analysts built their forecasts around them. But recently, something did not add up. According to a newly released report, the official numbers told one story, while the actual trade data told a completely different one. The gap between what was reported and what truly happened was not small. It was massive. In fact, the real number was reported to be many times higher than what central banks had officially admitted. This raises a serious question. Why would the most sophisticated financial institutions in the world choose to stay quiet about how much gold they were really buying? The answer, according to many analysts, lies in strategy. Central banks do not want to alert the public too early. If ordinary investors knew the full scale of this buying, prices could move faster than these institutions would like. So instead, they let the numbers leak out slowly, hidden inside vault movements and international trade flows, rather than clear public statements. This is an important lesson for every serious investor and entrepreneur watching this trend. The smartest financial players in the world rarely announce their true intentions. They let their actions speak, while their words stay calm and neutral. Anyone hoping to understand where money is truly flowing must learn to watch behavior, not headlines. And the scale of this behavior tells its own story. Hundreds of tons of gold have quietly entered global reserves this year alone, far beyond what most economists had expected. This is not the action of institutions that believe gold is losing its importance. This is the action of institutions preparing for something much bigger. Interestingly, this trend is not only happening behind closed doors. A growing number of younger investors, many in their 20s and 30s, have also started paying attention to precious metals for the first time. This is a significant shift. For decades, gold and silver were seen as something only older, more conservative investors cared about. Now, a new generation is beginning to ask the same question that central banks seem to already know the answer to. Is the financial system quietly preparing for a major shift in how global wealth is stored? This change in attitude does not happen by accident. It usually happens when enough people start noticing that the foundations of the traditional financial system are no longer as stable as they once seemed. Rising government debt, currency printing, and economic uncertainty have pushed many people, both young and old, to look for assets that cannot be created out of thin air. Gold and silver throughout history have served exactly that purpose. What makes this moment particularly important is the timing. While central banks have been quietly accumulating gold, the public price of both gold and silver has actually been falling. This creates an unusual and important situation. The world's largest financial institutions appear to be buying aggressively at the very same time that public sentiment toward these metals has turned negative. This is not the first time history has shown this pattern. Time and again, periods where confidence is low have often turned out to be the very moments when the most experienced financial players were positioning themselves for the future. The general public tends to react to price, while professional institutions tend to react to value. And when those two groups disagree this strongly, it often becomes a signal worth paying close attention to. So while the headlines may not be shouting about it, the data is quietly telling a different story. Central banks are buying more than they admit. Younger investors are entering the market for the first time. And the price, despite all of this hidden demand, has continued to slide lower. This sets the stage for the next, deeper layer of this story, where the actual charts begin to reveal something even more surprising. Because while the accumulation tells one part of the picture, the technical patterns forming right now suggest that something significant may be approaching far sooner than most people expect. While most investors were busy watching the price of gold and silver fall, something far more interesting was happening just beneath the surface. It was the kind of signal that rarely gets noticed by the average person, yet it has historically meant the difference between panic and patience. For nearly 5 months, gold and silver had been sliding lower. Many investors who had entered the market with excitement just months earlier began to lose confidence. Some sold their positions completely. Others simply stopped paying attention, convinced that the best days for precious metals were already behind them. But analysts who study price behavior closely noticed something unusual happening within the mining sector. Mining companies, which are the businesses responsible for digging gold and silver out of the ground, did not follow the same path as the metals themselves. While gold and silver kept falling to new lows, the mining stocks refused to do the same. They held steady, and in some cases, they even climbed slightly higher. This kind of disagreement between two closely connected markets is known among professional analysts as a divergence. And historically, this particular type of divergence has carried real significance. When the companies that profit from selling a resource start behaving better than the resource itself, it often means that experienced investors inside that industry see something the general public does not yet see. Think of it this way. If a business owner expects prices to keep falling, they usually act cautious, hold back investment, and prepare for harder times. But if mining companies, the very businesses that depend entirely on gold and silver prices, are not behaving this way, it suggests something deeper. It suggests that those closest to the industry believe the worst may already be priced in. At the very same time, another signal began to form, one that on the surface looked far more frightening. A pattern known as the death cross began appearing on gold's price chart. To anyone unfamiliar with technical analysis, the name alone sounds alarming. It is a moment when a shorter-term average price line crosses below a longer-term average price line, a pattern traditionally associated with continued weakness ahead. For many casual investors, seeing this pattern would be enough reason to panic and sell. After all, the name itself suggests disaster. But history tells a very different story for those willing to look closer. The last time this exact pattern appeared in the gold market, the price did not continue falling, as the name might suggest. Instead, it marked the lowest point of that entire downturn. What followed was one of the strongest rallies gold had seen in years, with prices climbing dramatically higher in the months that followed. This creates an important lesson, one that applies far beyond just gold and silver. Patterns that appear frightening on the surface do not always behave the way their names suggest. Markets are driven by human emotion as much as by data, and sometimes the moment of greatest fear is exactly when the underlying conditions are quietly shifting in the opposite direction. This is why experienced investors often say that the crowd tends to be most convinced of disaster right before a turning point begins. The very fact that so many people had already given up, selling their positions and walking away from the market entirely, may itself be part of the signal. When confidence reaches its lowest point, and the loudest voices are the ones predicting further collapse, history has often shown that conditions are closer to a bottom than a continued decline. None of this guarantees what will happen next. No chart pattern, no matter how reliable in the past, can promise a certain future. But what these signals do offer is perspective, a way of looking past the emotional noise of falling prices and focusing instead on what the underlying structure of the market is actually showing. And as both the mining stocks and the historical pattern point toward a possible turning point, another layer of this story becomes even more important to understand, one that has nothing to do with charts at all, but everything to do with human psychology, and exactly where the public's emotions sit right now within the larger cycle of fear and greed. There's an old idea in finance, one repeated for generations by some of the most successful investors in history. It says that markets move not just because of numbers, but because of emotion. And right now, that emotional cycle may be telling a story far more important than any single chart or report. The idea is simple. Every major market, whether it is stocks, real estate, or precious metals, tends to move through 4 emotional stages. It begins with pessimism, when almost nobody believes in the asset and most people have walked away. It then moves into skepticism, where a small number of people start noticing value, but the majority still doubts them. After that comes optimism, when confidence grows and more people begin paying attention. And finally, it ends in euphoria, the stage where everyone, even those with no real interest in finance, suddenly wants in. According to this framework, the most dangerous time to buy is during euphoria, when excitement is at its peak and prices have already risen dramatically. The best opportunities, historically, tend to appear much earlier, somewhere between pessimism and skepticism, long before the wider public has noticed anything at all. So where does the current gold and silver market sit within this cycle? Based on public sentiment and overall enthusiasm, many analysts believe the market remains somewhere between pessimism and skepticism. This may sound surprising to anyone who only follows headlines, especially after gold and silver experienced strong gains earlier this year, but true euphoria looks very different from a few exciting weeks of price movement. One simple test, used informally by experienced investors for decades, involves listening to everyday conversations. The idea is that when ordinary people, those with no background in finance or investing, begin offering confident predictions and hot tips about a specific asset without being asked, that is usually a sign the cycle is nearing its peak. It means the crowd has fully arrived, and historically, that is often close to the moment when smart, early investors begin preparing to step back. So far, that kind of widespread casual excitement around gold and silver has not happened. There was a brief moment of increased interest earlier this year, but it faded quickly. It never reached the level of obsession seen during true periods of euphoria in other markets throughout history. The general public remains largely uninvolved, distracted, or simply unaware of what has been happening behind the scenes. This absence of crowd excitement becomes even more significant when paired with another long-term factor, one that has nothing to do with emotion at all. For several consecutive years, the world has been consuming more silver than it has been mining. This means existing silver supplies are quietly shrinking year after year, while industrial and investment demand continues to grow. Unlike emotional cycles, which can shift quickly, this kind of supply imbalance builds slowly and does not disappear overnight. Put these two factors together, and a clearer picture begins to form. On one side, public emotion remains far from the excitement that typically marks a market top. On the other side, a real physical shortage continues to build beneath the surface, unaffected by headlines or short-term price swings. History has shown again and again that the most significant market movements tend to happen quietly, before the wider public ever notices. By the time everyday conversations turn to a particular asset with excitement and confidence, much of the major movement has often already occurred. This raises an important question for anyone paying close attention. If the emotional cycle has not yet reached its peak, and the physical supply situation continues to tighten in the background, then the real story may still be in its earlier chapters, not its final ones, leaving the most important developments still ahead, especially as deeper structural forces in the global economy continue moving in the background. Behind every price chart and every emotional cycle, there is always a deeper story, one written not in daily headlines, but in the slow, structural decisions made by governments and institutions over years. And when it comes to gold and silver, this deeper story has not changed, even while prices have moved up and down. For more than a decade, the governments around the world have continued borrowing at a pace many economists describe as historically unprecedented. This is not limited to one country. It is happening across nearly every major developed economy. Debt continues to rise, and along with it, the pressure on governments to manage that debt through continued currency creation. This matters deeply for anyone trying to understand the long-term value of money itself. When more currency is created year after year, while the supply of gold and silver remains limited by what can actually be mined from the earth, the relationship between the two naturally shifts over time. This is not a new theory. It is one of the oldest principles in economic history, repeated across centuries and across civilizations. At the same time, something else has been quietly unfolding on a global scale. Several major economies have begun deliberately reducing their reliance on the US dollar as their primary reserve currency. Instead, many have started increasing their gold holdings as an alternative store value, a process often referred to as diversification away from a single dominant currency system. This shift has not happened overnight, and it has not been loudly announced. Like the central bank buying discussed earlier, it has unfolded gradually through policy decisions and reserve adjustments rather than public declarations. Yet, its long-term effect on gold demand remains significant, regardless of short-term price movements. In recent months, gold and silver have also faced a temporary headwind, one connected to excitement in unrelated parts of the financial markets. Increased speculative interest in other high-growth sectors has, for a time, increased demand for the US dollar, creating short-term pressure on precious metals prices. However, analysts studying these patterns note an important distinction. Temporary shifts in capital flow are very different from permanent changes in underlying value. One is driven by short-term excitement. The other is driven by decades of structural economic behavior. This distinction matters enormously for anyone trying to separate noise from substance. Prices can move sharply in the short term due to speculation, sentiment, or unrelated market trends. But the core reasons gold and silver have remained valuable throughout history, rising debt, currency creation, and global diversification away from any single currency, have not disappeared. If anything, many of these forces have only grown stronger over the past several years. This is the central lesson at the heart of this entire story. The price of an asset and the underlying reason for its value are not always the same thing. Prices can fall while the long-term thesis remains completely intact. History has shown this pattern many times before, often right before some of the most significant turning points in financial markets. For serious investors, entrepreneurs, and anyone responsible for protecting long-term wealth, this distinction between price and value may be the single most important takeaway from everything discussed across this story. Short-term volatility will always create noise, fear, and uncertainty, but underneath that noise, the structural forces shaping the future of gold and silver continue moving forward, quietly, deliberately, and largely unnoticed by those who only watch the headlines. You said, write a highly SEO-optimized YouTube video description of about 150 words.